So you made a pile of dough last year. Now we're rolling into tax season, and Uncle Sam is about to take a bite out of it. How big a chunk will that be? And how will the new tax law change that? I'm Richard Rubin, and we're talking taxes. Let's think of your 1040 as a recipe. We'll see how much dough goes in your bowl, what's not taxed, and how much goes in the IRS's bowl. Let's get cracking. Let's get cracking. Step 1, figure out how much dough you've made. That's your income. Step 2, off the top, take out your 401k contributions, wrap them up, and put them in the freezer. They're not taxed, but you can't eat them until you're old and hungry. Next up, the standard deduction and personal exemptions. These won't be taxed, so they're just gonna go right into your bowl. For tax year 2017, the old rules still apply. So if you're a married couple with 2 kids, you get 4 personal exemptions. That means for each person in your household, $4,050 go into your bowl. Then you get the $12,700 standard deduction. That totals $28,900. But Congress just rewrote that part of the recipe. Now, there's no more personal exemptions. If you're a married couple, you get a $24,000 standard deduction. If that looks a little bit smaller, it is. But that doesn't mean you pay more in taxes. Of course, if you have a big mortgage or state taxes or charitable donations, you can probably keep more in your own bowl. But let's keep this simple and standard. This is all yours, so do whatever you want with it. Eat it raw, toss in some candy, whatever. Remember this big pile of dough? Well, yeah, the government's gonna take some of that. How much? It's time to preheat the oven and go to step 3, tax brackets. For a married couple, the government is going to take 10% of the first $19,050 that's still here. And then it's going to take 12% of the next $58,350. The more you make, the bigger the government's bite is. If you're all the way at the top, above $600,000, the IRS will get 37% of your last dollar. The new rates are generally lower than those in the past. But wait, there's more. Step 4, tax credits. That's when money goes from the IRS's bowl right into yours. Let's consider the child tax credit. It used to be $1,000 per kid back from the government into your bowl. But now, it's $2,000 for each kid, back from the government into your bowl. For most families, the $2,000 credit is actually better than the $4,050 personal exemption from 2017 that's going away. Why? Let's take a look. The $4,050 is the deduction. If you don't get that deduction anymore, it's income. And with income, we do what we did before. We flatten it, we cut it, and then the IRS gets a bit. If you're in the new 22% tax bracket, that $4,050 exemption would have saved you $891. The $1,000 increase in the child tax credit would be better for you. But there are some catches to think about while we wait for these to bake. Children age 17 and up only get a $500 credit. But for 2018, 80% of households will get a tax cut. Wait, you risk losing. Sorry,